Good morning. It's Wednesday, the 6th of November, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. This is a late edition core report as we track the US presidential elections. And before we start off with the rest of the show, polling is over in the United States for the presidential elections and counting is on. Donald Trump was leading around 7 a.m. in key states, but this might be a little early to call at this point. As a reminder, the stock markets and the Forex markets, among others, have been pricing in a Trump win. So to recap, what are the key issues at stake within the United States and from outside looking in, including from countries like India? I reached out to Raymond Vickery, Senior Associate, Center for Strategic and International Studies, and a former U.S. Assistant Secretary of Commerce, Trade Development, and an old India hand to get his take. And I began by asking him to talk about what are the major issues that were at play going into the elections.
I think that there's a lot at stake here. If you look at the issues, the exit polls from Pennsylvania show that the number one issue is defense of democracy. And there are many, many people who are concerned about it, particularly coming out of the 2020 election when former President Trump said that he, in fact, had won. And when you strike at the integrity of elections, you strike at the heart of democracy. India has gone to great lengths in terms of its electoral system to assure full and fair elections. We're doing the same thing here. And I think the good news on that particular issue is that across the nation, we have had so far the most secure and straightforward election that we've ever had. So defense of democracy is very important. If you look at those same exit polls in Pennsylvania, however, the number two issue is the economy. And the economy, whether you're in India or the United States or any other great democracy, is going to be foremost in people's minds. The Trump side has been able to paint a picture of vast achievement under President Trump and destruction of the economy under President Biden and Vice President Harris. Really, the facts don't bear this out at all. In fact, if you have GDP growth, it's about the same, and the claims that Trump had that it was the best in history just are wrong. I mean, there are about 8 presidents since World War II in the United States who've had a better GDP growth. That having been said, you do have the problem coming out of the pandemic of having pumped up our economy to keep people employed, which has had some hangover in regard to inflation, particularly in regard to the price of groceries. And that's something that people see, and it's something that Trump has been very good at demagoguing on to be able to convince people that there was a golden age back when he was president and not now. I think that those are very clear kinds of issues which are moving people, as is immigration. Trump has painted this picture of vast numbers of criminals, people from insane asylums coming over the border. You may recall in the debate he talked about Haitians eating the pets, dogs and cats of people in Ohio. None of that's true, but we do have a problem with immigration. Everybody can see that. In fact, there was a bipartisan bill to be able to address it and solve it, and Trump, in essence, vetoed it by calling up members of the Senate and House. So those are main issues. On abortion, it's very clear. Trump takes the position that he rightfully was able to stack the Supreme Court and overturn Roe versus Wade. Kamala Harris, very much for a woman's right to choose. One of the things that's very interesting to me is with all the climate disasters we've had in the United States, whether it be in Western North Carolina floods or the vast number of forest fires out in the West, climate change and what you do about it has not seemed to move many votes in this election, which is an area in which there is a vast difference between the candidates. President Biden with Vice President Harris in the same administration have gone all in on things like electric vehicles, on subsidies for saving the electricity. But that doesn't seem to have moved many votes. I think those are primary issues at this point.
Right. And the other question is really now from an outside in, and this is really more of geopolitics. So for the new president, what would you feel are the key concerns today, and how would they likely go depending on which president came in? And therefore, what could other countries, like including India, maybe be watching more closely?
Well, let's take the economy. Trump has made great strides in terms of emphasizing grocery prices and inflation. But his measures that he wants to put in can be some of the most inflationary measures of all. He said 10 to 20% on all imports across the board, whether they're from friends like India or whether they're from adversaries. Now, that's going to do one thing. That's going to run up a lot of prices very, very rapidly. In addition, he wants to reenact the kinds of tax cuts for the richest Americans to pump yet more money into the system, and at the same time increase the deficit. So I think that with India, the economic relationship is very, very important. Instead of looking at across the board tariff increases, and as you know, Trump has badmouthed India as one of the chief culprits in terms of international trade, you have with Kamala Harris a concept of friend sourcing, and that is trying to move supply chains from unreliable partners like China to partners like India. And not saying, yes, we're going to try to build economic fortress America and exclude the rest of the world. That's very attractive in demagoguing. People think that somebody else is responsible for whatever economic problem they're having. But I think that that's a major, major area. I think on relations with other countries about meeting the challenges such as China, which still, in spite of what's happened on the border, claims an entire Indian state, Arunachal Pradesh, then the question is how best to get China to play by the rules of the game and international rule of law. And in that regard, Trump has a transactional approach. If you got to pay up and you will pay in, yeah, maybe we'll stand by you. If you're not doing right, we're not going to do that for you. The Biden-Harris approach has been that of the Quad, and that is taking the democracies of Asia, particularly Japan, Australia, India, the United States, which is a Pacific power, and saying, yeah, we're going to work together. And it's not going to be transactional. It is in the United States' interest to be able to see that India has the tech transfer to make it a prosperous nation and a great partner in regard to China. So I think that that's a major difference.
Right, Mr. Vickery, we've run out of time. Thank you so much for joining us.
Thank you, Go. It's good to see you again.
The Take. I read an interesting column titled How Finance Influencers Use Storytelling to Misguide People. For instance, with headlines like, "This is how I made 5 crore rupees in 1 year," essentially targeting insecurities amongst the younger generation and then pushing them to speculate in the stock markets. As the author of this article, Sandeep Das, a former management consultant at PwC, writes in Mint, influencers tap into multiple emotions at the same time: fear, anguish, FOMO, or fear of missing out, and even ridicule. For example, do you still invest in fixed deposits? Speaking of fixed deposits, it's a good time to bring up the SEBI report, or Securities and Exchange Board of India report, that highlighted the fact that 9 of 10 individual traders in futures and options lost money in 2024. So you would have been better off putting your money in a fixed deposit, or for that matter, even under the mattress. Speaking of mattresses, that is, if you had the cash to start with and did not borrow it off a buy now, pay later kind of app. Thanks to influencers or otherwise, millions of youngsters would have lost their collective shirts in the last couple of years. Now, the precise impact of this may never be too clear since the losses would have been absorbed by families or longer loans. The outlets are many. Apart from reckless derivatives trading, which is now well documented, some would have lost in cryptocurrencies or in crypto trading. Others have lost and will lose money in the stock markets. Some because they just may not have the patience to wait for the markets to recover from the fall that we are seeing right now. And of course, not all who've lost out are youngsters. But even more will lose because they have borrowed to start with and interest rates are high and it gets compounded with delays. So whether it was for a now distant holiday or a high-priced smartphone, the true cost of money will be increasingly felt now and it will bite. Because incomes have not kept pace with aspirations. And so today, for a variety of reasons, including regulatory actions on all sides, the party is ending or at least shrinking. Staying with the markets, it's clear that smart stockbrokers feasted on the general ignorance by creating content and luring more unsuspecting young users via a pliable and amplifiable social media system, and they continue to do so, many of them barely having seen a single full market cycle themselves. While the SEBI has woken up to the prospect of regulating the many get-rich-quick advice dispensers, not all are covered, including the stock brokerages, large and small. So this is a good time to take stock, quite literally. When markets rise, as they have been in the last few years, making money feels simple and is the equivalent of throwing a dart at any random point on the dartboard, knowing that you will hit bullseye. Smart investors actually wait for moments like this. Foreign portfolio investors saw the writing on the wall in late September when they realized companies were not going to turn in good results and that earnings-driven growth was fizzling out. Not surprisingly, they've been selling since, close to $11 billion by now. The amount is not large in proportion to their holdings, which must be close to $800 billion or more, but it is the strategy which is worth noting. Institutional players in the derivatives market have been smart too, and smarter than you and me for sure. Even as small traders lost their shirts, once again, to remind you, the big proprietary traders, that includes foreign institutional investors, made a profit of close to 60,000 crores in the last financial year, many of them using algorithms. And not surprisingly, even back in the equities markets, they've been selling close to $11 billion in October. Now, this amount is not large in proportion to their holdings, which must be close to $800 billion or more, but it is the strategy which is worth noting and the fact that there are smart investors in the market. So whether it's in derivatives or in equities, you have to remember that there are smart investors who are at least smarter than you. As foreign investors have sold, Indian investors have continued to pump money, including substantial amounts through mutual funds. Not that Indian savers or investors have much choices in a high inflation environment. So hopefully the 8% correction, which we are seeing now, which could go to 10% if I go by what some market strategists are telling me, will cause us to pause and think again about what it really takes to make money. And that while external facts like the US elections have some role to play in the medium to longer term economic outlook, that has little to do with the fundamental question of why small cars are not moving out of dealerships or the low-cost housing sector is not doing well. We should think of that and focus on the real story and not the storytelling that tends to mesmerize us. And that brings us to the top stories of the day. The stock markets rise in a relief rally after an 8% pounding from the peak. The rupee hovers around a record low. What could turn it around? And America's retailers say families could spend up to $7,600 more per year if tariffs were increased on just 6 consumer product categories.
This is a core report with Govindraj Ethiraj.
The stock markets recovered on Tuesday after the pounding that they received on Monday. The rally appeared to be more of a short covering and relief rally and could thus have some more legs. The Nifty 50 has dropped almost 8% from the record highs the markets hit on September 27th or roughly 5 weeks ago. Indian markets since then have been on a downward journey, while other markets, including Asia and the United States, have been moving up. Tuesday's rally was led by financials and metals, the latter because it appeared that prices would rise because of more stimulus by China. A fund manager told Reuters that investors were parking their funds in segments with valuation comfort ahead of key events like the presidential election. The Sensex rose about 1,226 points on Tuesday from the day's low. So in final close, the Sensex was up about 694 points at 79,476, while the Nifty 50 was up 217 points at 24,213. So investors are also looking at a potential Federal Reserve interest rate cut of 25 basis points at its policy announcement on Thursday, which means more liquidity in the markets. And that could potentially help India, but whether it will do so in the near term is not clear. Asian markets are still ruling strong, with markets like Japan, China, and Hong Kong all up on Tuesday. All these markets have been rallying ahead of the US elections, along with Wall Street, which of course has been pricing in a Donald Trump victory. Only the Indian markets have now diverged since late September, ever since FIIs have been selling on falling earnings and demand slowdown in the economy. Elsewhere, oil prices have edged up once again and are now quoting around $75.42 a barrel, thanks largely to the fact that Middle East tensions have not subsided and the oil-producing countries are holding out on increased production. Where is the rupee headed? So the Indian rupee was nearly unchanged on Tuesday, but under pressure from foreign outflows from domestic stock sales and of course constant intervention by the Reserve Bank, which has kept the band tight. The rupee closed at 84 rupees 10 paise against the dollar compared to its previous and record low close of 84 rupees 11 paise on Monday. So where is the rupee headed and what are the factors that will determine its fate in coming months? Remember, one key reason for the rupee's weakness, along with other Asian currencies, is the strong dollar, reflecting, of course, the strong US economy, which we've discussed here earlier. I spoke with Amit Parbari of CR Forex in some detail on what was going on in the Forex markets and, of course, in the context of the rupee and the pressures it was facing in the region and in the world. I began by asking Amit how he was seeing the rupee in recent weeks.
Let us see how all currencies have performed against dollar. If I have to compare dollar index in last 1 month, dollar index becomes stronger by close to 2.76% from 1st October to 31st October. That is 2.76%. Chinese currency got weaker approximately by 1.45%. South African rand got weaker by 1.02%. Malaysian ringgit got weaker close to 5%. So basically, dollar have got stronger in last 1 month because of which all emerging market currencies have got weaker. Now, definitely they have outperformed all other emerging market currencies. Rupee have got weaker by mere 0.20% between 1st October to 31st October. You can say that RBI had done a good job in protecting rupee weakness, and that data you can get it from reserve data. Also, that reserves have also fallen down below $700 billion. So this was one of the reasons why, all currencies got weaker. We have also got weaker.
So you're saying that the dollar is obviously on a very strong wicket right now and it is continuing to power ahead. So what could change that?
Now, there are two data points. If you have to predict what is going to happen in the future, you have to understand what state of economy is in US right now. No matter what, whoever wins tomorrow, either Kamala Harris or Donald Trump, whatever they have said in their electoral campaign, based on that, we are able to understand that their deficit is going to increase. In future, if whatever they are saying, they do exactly the same. If that deficit is going to increase, then one of the biggest problem in US currently is their rising debt. That has gone to $36 trillion. So $36 trillion है. अब उसका इंटरेस्ट पेमेंट is how much? इंटरेस्ट पेमेंट है जो फेड का रेवेन्यू है उसका approximately 25% they are paying as interest payment. So basically, because of this reason, Fed is bound to cut the interest rate. If Fed is going to bound the interest rate at the fastest level or at a higher level, then dollar index, which is currently trading near 104 kind of a level, we think that 105 to 106 is going to act as a very, very strong resistance for dollar index, and gradually dollar index is going to move towards 102. That is the first target. Second target 100. And by 2025, we will not be surprised if it goes below 100 and start trading near 97.5, 98 kind of a level. If dollar index gets weaker, then all emerging market currencies have to get stronger.
Right. So that's from the dollar side. If you were to look at the intrinsic strength of the rupee or the intrinsic value of the rupee, how are you seeing that right now? Because obviously some of it is influenced by the fact that we've seen these huge FII outflows, more than $10 billion in October alone. So that's what's happening here. Is there any other such intrinsic or domestic factor that's playing?
I knew this question is going to come. This is an obvious question. Everyone is worried about that FII had sold close to $11 billion in the month of October itself. Now, let me give you a couple of more data points. FII holding in Indian equity market is close to $750 billion to $900 billion, approximately giving it to $800 billion. $800 billion का उनका market पे value invested है. If they are taking away 11 billion, that is not a big number. I think they have just done rebalancing. जो भी stock overvalued होंगे उसको उन्होंने profit book किया होगा just before US election. That is very, very obvious. Now, the question is whether they are going to come back to India after US election. I think they should and they will be coming. The entire fundamental reason is that India's growth story continues and it is going to attract people to put money in India. Underweight हो सकता है, overweight हो सकता है. They might select some other EM के basket पे. There will be more overweight. In India, there will be underweight. But it will be completely wrong on my side if I will say that they are not going to come back. They are definitely going to come back. We are expecting them to come back, post Christmas, in the first week of January or second week of January. They can again come back in a full-fledged manner.
Right. So, I mean, whether or not that determines the value of the rupee. So, therefore, are you also saying that the rupee could, from here on, strengthen a little bit?
Technically speaking, rupee should ideally be trading close to 83.5 or 83 kind of a level. I will justify my point why I feel that rupee should trade close to 83.5 level or 83 level. Let me give you a data point. In 2022, crude was trading at 140, 135 पकड़ सकते हैं at the peak of Russia-Ukraine war. From that level, crude has come down almost by 50%. So crude currently is trading at $70 per barrel. Rupee at that point of time in October 2022 was trading near 83 level. Now crude has fallen down by 50%. At the peak 2022, dollar index was trading close to 114 kind of a level. Dollar index from 114 has come down to 104 kind of a level. Rupee was trading at 83, rupee is trading at 84. So basically, whatever flows came, RBI went on in the market and started observing dollar. So if I have to compare the data point, I personally seen that rupee should trade near 83.50 and 83. So after it, rupee getting weaker towards 85 or 86, that probability I will count less than 3%. Ideally, if flows come in and RBI will not intervene on the buying side, then ideally rupee can move lower. And how do we understand that RBI is not buying dollars? So 83.50 will act as a pivotal point. If 83.50 is broken, then rupee can appreciate by 50% to 1.5 rupee in a fast and furious manner. So any exporter who is thinking that rupee is going to get weaker and he is keeping his position at highest level of risk, ideally exporters should go and hedge their exposure. That is what we are recommending to our clients.
Great. Wonderful to hear that. Thank you so much for joining me, Amit. America's tariff impact. There is, of course, a good chance that America will raise tariffs in some way or the other across many, many products, regardless of who the president is and which way the election goes. The point is that America First will be a key focus of the incoming administration, according to Federation of Indian Exporting Organizations Director General Ajay Sahai, as he spoke to me yesterday. A new report by America's National Retail Federation has said that a universal tariff of 10 or even 20% on all imports into the United States from all countries, or an additional tariff of 60% on imports from China on top of existing tariffs would have a significant impact on the costs of a wide range of consumer products sold there. The Federation says that the conclusion across research has been of a net negative impact on the United States, with results ranging up to $7,600 in additional costs per household annually. So this study focused on 6 consumer product categories found in nearly every home across the United States: apparel, toys, furniture, household appliances, footwear, and travel goods. As an aside, if you are traveling or if you were thinking of traveling to the United States for shopping, I really think you should think again. So to come back, this report concluded that for all the categories examined, total average tariffs would exceed 50% in the extreme tariff scenario, up in most cases from single or low double digits currently. All of this would reduce American consumer spending power by $46 to $78 billion every year if the tariffs are in effect. And this accounts for alternative sources of supply and potential new US production. The report says while the impact as a share of the US economy may seem small, it's a different story for individual products, including many consumer products whose prices are already inflated by extra tariffs on Chinese imports. The Federation also argues, well, not surprisingly, that these additional costs will not be passed on by retailers because they're too high, and obviously when passed on to consumers would result in prices higher than what many of them would be willing to pay or even able to pay. Some, of course, would continue to buy while others would stop. So some specific categories, consumers could pay anywhere between $14 to $24 billion more for apparel, $9 to $14 billion more for toys, $8 to $13 billion more for furniture, $6 to $11 billion more for household appliances, $6.5 to $10 billion more for footwear, and about $2 to $4 billion more for travel goods. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.